So very good morning everyone. So today in this session, first we are going to analyze the ratios regarding Tata Consultancy Services. Regarding the group Tata, if I have to analyze the financial results for the year ending 31st March 2023, as I already said now, once after completion of subject discussion, we can practically analyze the stock ratios. Now we are going to analyze the whole group Tatas with regard to their financial ratios, how they performed during the year. I will show you the P&L, the profit and loss account statement, and the balance sheet of this particular company. Using that, in this session, we are going to practically analyze how TCS has performed in the last year. We are going to make intra-firm comparison. Which comparison we are going to make? Intra-firm comparison. Intra-firm comparison means comparing TCS past with the TCS present. Are you understanding? Present represents, this balance sheet. Means comparison of 22-23 balance sheet with the 21-22 balance sheet. Means March 22 comparison with March 23. We are now going to do in this session, absolutely we are sticking on our discussion in practically analyzing Tata Group. Listening? Clear everyone? Are you all ready to analyze all the ratios? Once we complete the ratios from today onwards, whenever you see the balance sheet of any company, you will be in a position to tell whether this is a good company or a poor performing company. You can have a clarity. Listening everyone in the class? So many ratios, we are going to take a bunch of ratios we are now going to calculate. Please open your notes as well. Let us practically analyze all the ratios. How many years we are going to do like that? 2 years. Ratio analysis chapter is there with you. Oh, notes is there or not? In the same notes continue. This will not be available in ISM. Sorry, if not connected, leave it. See here. First let us analyze how the financial results has to be read. See here. Shall we? See the screen. Always one should understand that this will be the final audited financial statements. Of a company called as Tata Consultancy Services Limited. Regarding the company called as TCS. Okay. This is digitally signed by, this is called as a digital signature given by the company secretary of that particular company. So see here. Let me first analyze how to read the financial results. There are two types of financial results. Number one, interim financial results. Second one, annual financial results. Repeat, what is the first one? Second one? There are two types of financial results. First one is interim financial results. Second one, annual financial results. You start as an investor of a particular company. There are two types of analysis. Technical analysis, fundamental analysis. First one, First fundamental. Fundamental analysis, technical analysis. Okay. There are two types of analysis of a particular stock. I wanted to become an investor. Soon I want to become like Warren Buffett. What I should do? First you should have patience. Patience of learning. Okay. First what we need to do, you should understand how a stocks perform. Using what information in the market, using what set of information, we can make a meaningful interpretation of the data. So let me explain this. I wanted to become an investor in TCS. How to know whether I should invest in TCS shares or not? Two types of analysis you have to make. Number one, fundamental analysis. Second one, technical analysis. Are you understanding? Today I am going to analyze about the fundamental analysis. Are you understanding or not? People over the YouTube channels, etc., they are earning lakhs of rupees just on creating the courses on fundamental analysis. Course on fundamental analysis. They will create a course worth 5 hours or 5.5 hours. Charge around 10,000, 15,000 like that for that course. There what they will learn, they will give a lifetime access of videos and they will give you the idea about how to analyze the stocks. Listening or not? Properly, if you do CA Inter, you need not do all those. Rather than learning in a bookish knowledge, like today we are going to analyze the TCS balance sheet. Sir, if you can do for TCS, you can do for Infosys, you can do for Ashok Leyland, you can do for Tata Power. Listening, how to understand the financial statements and how not to analyze. How not to analyze the company also I will tell you. See there. First, number 1. Financial results for the year ended 31st March 2023 and a recommendation of what dividend? Final dividend. I will ask you one question. Please listen. Dividend will be paid on what? Share capital chapter completed or not? Dividend will be paid on what? Answer. Dividend will be paid out of what? I am not asking. Question A, you are not listening. Dividend will be paid on what? I am asking. Not out of what? Paid on what? Market value or par value? Everyone? Okay. Now answer my question. Okay. Tell me. Par value 10 rupees. How much dividend you can pay? Par value 10 rupees. Market value 100. Market value? Par value 10 rupees. You will pay dividend at 100 rupee basis or 10 rupee basis? Answer. That means can I pay dividend more than 10? Answer. Yes, it is possible. Yes, it is possible. Who told that it is not possible? Where it is there in Companies Act like that? You should pay on par value. That's all. You should pay on par value. Par value 10. Pay 25 times the par value. 250 dividend also you can pay. This is what share capital chapter wanted to convey. Share capital chapter section number 44-45. Numbering of shares and payment of dividend on the amount paid up. When you see there what they will tell, whenever dividend has to be paid, it will be paid in proportion. In proportion to the paid up value. In proportion to the 10 rupees is the paid up. How much? 10 rupees. I can pay 5 times the paid up. Proportion is 5:1. That's all. This is what said in Companies Act. They didn't tell that you should pay only to the extent of par value. TCS, do you know how much dividend paid? 24 rupees they paid on a par value share of 1 rupee. 24 times. How much? 24 times. Proportion is 24:1. For every 1 rupee, how much dividend they paid? 24 rupees dividend they paid. This is a classic example that dividend is not paid on par value. Wrong learning. Dividend is paid in proportion to the paid up value. Paid up value 1 rupee. 24 times you can pay. Sir, cannot or you should not ask question. Live example is there before you. If a TCS also I don't believe means I can't do anything. Understood the point? First point number 1. Learning number 1. What you learned? What you learned? Dividends are paid not on the par. It will be paid in proportion to the paid up value or par value. This is what Companies Act section number 44-45. 47. Listening? And the proportion of paid up pay you should calculate. Not on the par value, not on the paid up value. Sir, TCS if it paid dividend on the par value, 1 rupee they can pay. Who will invest in that company? Understood the point or not? Who will invest in that company if that is like that? Okay, na? Greatness of this company is share is trading at 3,600. Share is trading at a par value of 1 rupee. 1 rupee is the par value. Market value is 3,600. You can imagine the value of that company. It's a gold. It's a gold. That company share a gold. Which company? TCS is gold. As a company, I will not call it company. That company is a heap of gold. Any 1 gram gold you purchase, better buy TCS share. Are you understanding the point or not? So, that company itself is a gold. So, Tata Consultancy Services, that company each share is trading at 3,600, par value 1 rupee. Understood the point clearly? Now listen carefully. This is a situation of this company. Now further, let us understand. Board meeting held today. Directors have recommended. Who have recommended? Have recommended final dividend of 24 of a 1 rupee share. Of a 1 rupee share. As per section number 123 subsection number 5, dividend once declared should be transferred to a separate account within 5 days. Within how many days, sir? 5 days. Therefore, they are transferring within 4th day only. They are going as per Companies Act, against to Companies Act. The beauty of Companies Act, you will see, once you practically do something rather than bookish reading the concepts. Okay? See that. Audit report, all these in auditing you will learn. I'm not going to discuss about them and waste your time. Mainly, let us come into the concept. See here. Shall we? This is called as consolidated. No one, don't interrupt me. Okay? Please, listen first. When you don't know, listen. Don't make side comments. This is called as consolidated financial results. Everyone repeat what it is called as. Means TCS is having 6 subsidiaries. How many? Subsidiaries. All the subsidiaries put together, this is a result. That's why this is called as what? Consolidated financial results. This should not be analyzed. Do you know why? In this, lot many companies are there. Are you understanding or not? In this, lot many companies are there. I will give you an example. There are 3 players in a cricket. Example, 3 players. One player hit 100. Another player hit 1 run. Third player hit 2 runs. Am I clear or not? Third player hit 2 runs. First player hit 100. Second player 0. Third player 1 run. I said average out. 101 divided by 3. Almost 3. 101 divided by 3. It came to somewhere around 34 runs it came. Are you understanding or not? This is a correct interpretation of the result or wrong interpretation? If you give 34 credit to all the 3, then one batsman who didn't even play got an extra credit. One batsman who hit century did not even get the credit. Right interpretation or wrong interpretation? Same happens also with company. Consolidated results is not for decision making. It is only for overall view of the company. Listening? You should always take, using this information, no one should analyze ratios, because in this one company there are 7 companies are there. Some perform well, some may not perform well, some moderately perform. The color should not fall on the holding company. Therefore, I will analyze only standalone financials. Everyone repeat what we need to do. Standalone financials. Read this, what it is. Audited standalone statement of financial results. That means this is exclusively regarding which company? TCS. Now tell me first, it is in crores. 1,90,354 crores is the turnover. 2 lakh crores budget of South India. Seriously, each state is having around 45,000 crores of budget every year. All full South India, they can write a budget for 1 year. Only with one of their 27 companies. That is a group Tatas. So, like this, there are 27 companies for them. making a turnover of 1 crore crores. Okay, so they can buy India totally for 1 full year. So that is a wealth that they have generated. That poor fellow is walking like a normal person every single day, but he is such a great man, Ratan Tata. So for building an empire called as Tata and working like that for so many number of hours every day, even till date. So dedication matters. How dedicatedly they are doing their business. So okay, keeping all these things aside, emotions, all these things keep aside, let us see the ratios and how they performed over a 1 year period. Okay, compare these two and tell. This is 31 2022. This is 31 2023. Shall we start analyzing the financial results? Keep the heading in your notes. Everyone get ready with the calculators as well. Write down. Please write down. So write down fundamental analysis. Write down please. Fundamental analysis on the financial results of TCS 31/3/2023. So today's session exclusively we are discussing only about this, because so many people are also asking me every day, sir, when we are going to analyze the TCS balance sheet. So therefore it's better I will do today, so that you will also have a clarity as to how practically these can be applied in real life. Shall we begin? First thing, okay, tell me first, whenever we are analyzing a company, first what we should analyze about it? The liquidity ratios we have to analyze. Everyone repeat, what ratios we have to analyze? First, whether it is liquid and solvent in the short run or not, we need to check. Correct? For that, how many ratios are there with us? 2 ratios. One is current ratio, liquid ratio. Whether TCS is having a very good solvency ratio or not, let us check. Okay? Write down first. Number 1, analyzing the liquidity ratios over 1 year. Analyzing liquidity ratios over 1 year. We are not just going to write the numerical answers, we are going to analyze the stock. Okay. Lastly, we will give a judgment whether to invest in the shares or not to invest in the shares. Okay. On the basis of the comparison. Okay. First, please write down A. For the year 21-22, ending 31st March 22. First, you tell and write what is the first liquidity ratio. Current ratio. First write down the formula clearly. What is the current ratio? Current assets by current liabilities. Okay. See there and tell me. First, when we want to know current ratio, we need to check the balance sheet of P&L. Answer. Come to the balance sheet once. See here. Please listen carefully. All the amounts are given in lakhs or crores. All are given in crores. See here. Current assets. Inventory is a current asset or not? Yes. Financial assets. First, investments, receivables. Investment, receivables. What is investment? Current investments means investment held for not more than 1 year. Buy this year, sell this year. Generally. Okay. These are called as current investments. Cash and cash equivalents. Cash is a current asset or not a current asset? Next, after that, other balances with the banks. Next, I will ask a question, answer properly. Loans in the current assets means what? Short-term loans given by the company. Short-term loans. This is called as debtors for finance. Repeat, what they are called as? Debtors for finance. Ratio analysis chapter we have seen. Long-term debt to short-term debt we have seen. Like that, this is a short-term debt given by the company. This is also coming under which category? Current assets. Next one, other financial assets and all the other assets of the company. First, answer my question clearly. We are going to analyze which year first? 22. Next, we are going to analyze which year? 23. First, one by one, give me an answer. What is the status of current assets over a period? First, tell me, what is the current assets status in the first year? Here, what is the status? First, tell me, everyone in the class should answer this. Whoever wanted to invest in the shares, you should make a fundamental analysis of balance sheet. Tell me, performance has over 1 year period reduced or increased? Answer. Answer. Wrong interpretation. Unless and until you compare with current liabilities, how can you tell? And seeing this, you will tell. This is called as a wrong interpretation. Never interpret on the basis of current assets. You should compare it with what? Calculate the ratio and compare the ratio and tell. Sir, here maybe really current liabilities also are higher, ratio may be lesser, but don't come to a judgment just on the basis of the current assets total. That is not right. Listening? Now, Current assets total we had on hand now. 94, 192, 92, 784. Now tell me, what are the current liabilities? Tell the total. Directly they have given current liabilities. Tell me. 37, 901. 39, 324. Current liability increased or not increased? Answer. Increased current liabilities are there. Now you can make a comparison and tell whether performance, I can't tell performance, whether solvency has increased or reduced. We can judge using that particular thing. Correct or not, everyone? Shall we do that? Write down. Current assets by current liabilities. Tell me what is a current assets total for 31/3/2022. I will show you, at least see and tell. What is this? 94, 192. Next, 37, 901. Please tell me the ratio. 2.49 is to 1. Tell me, what is the ideal current ratio? 2:1. Having more than 2:1 is good, bad? Good, fantastic company that is. That means for 1 rupee current liability, they are having how much current assets on hand? 2.49 times the current assets they are having. Just like that left hand that they will pay. Are you understanding the point? But this is not the right indicator always. What ratio we have to calculate? Liquid ratio also we have to calculate. Are you understanding? So before going into that, how much is the ratio that we obtained? 2.49 is to 1. Which year this is? 21 and 22 financial year. So this is a current ratio. 2.49 is to 1. Write the comment. So the company is maintaining a very good current ratio of having rupees 2.49 for every 1 rupee current liability. Next, for the same year, what we need to calculate? Liquid ratio. Liquid assets by current liability. See there. Liquid assets represents what? Tell me. First one, liquid assets represent what? Cash plus receivables. Cash plus receivables. I will round off just to calculate those. Tell me. Inventory is a liquid asset or not a liquid asset? I told you why. Okay, inventory is a stock in the godown. Here TCS godown stock will not be there. Software is made but not yet sold. Listening or not, everyone? Work in progress, software development going on. Am I clear or not? Like that, sale has to be made, prepared but not yet sold. It is still in the form of inventory. Please see there, everyone. So this is inventory. Inventory should get converted into debtors. Debtors should get converted into cash. That means it will take time or will not take time? Will take time. Therefore, this will not be taken as a liquid asset. Investments, not a liquid asset. Okay, next one, trade receivables. Trade receivable is a liquid asset. Whether billed or unbilled, trade receivable is a liquid asset. Next one, cash, liquid asset. Bank balances, liquid asset. Short-term loans, liquid assets. Other financial assets are other assets we will not take. Shall we consider them? I will pinpoint them. Let us at least see them clearly. These are the things. Billed one is 35. Unbilled amounts are 7264, like that amounts are there. Can you see here? These are the two amounts we have to take. Okay, na? Next. After that, cash, other balances with bank. These two also we have to take. Next, loans. This one. These are all the various items that we have to consider with regard to the liquid assets. Please tell me, what are all the liquid assets in this company? Everyone repeat. Billed receivables, unbilled receivables, cash, balance with the banks, short-term loans. All these are called as what assets? Liquid assets. Shall we total all those? Everyone please total all these numbers. 29,852, 6250, 8197, 5495, 5653. One second. Tell me how much? 50? 55,000? 447. 447. Current liabilities already had we calculated or not? How much rupees? 37,000. 901 crore. Please tell me the ratio once. 1.46 is to. Tell me whether this is a good company or a bad company. Fantastic company this is, because even in the liquid ratio we require how much ratio? But they are maintaining how much? 1.46 is to 1. That means, tell me, for every 1 rupee of current liability standing at the doorstep, cash I can throw from left hand. Take this and go. How much amount they can pay? 1.46. That's the capacity of that company. That's why that's always become the darling of the Dalal Street. Because that company's stature is like that. At any point of time, they can sell all those and they can pay the liabilities. I mean current liabilities. So short term, this is solvent company or insolvent company? Need to doubt or need not doubt? Blindly invest in that company shares. Definitely it will gain you. It's a gold form. Sorry. Write down up to here. Liquid ratio. Liquid assets by current liabilities. Completed writing? Write the comment and go to the next year. So this company is a solvent in short run, not solvent in short run. It is solvent in short run and can meet all its immediate short term liabilities. From the next ratio onwards, this much detailed analysis is not required. We will make a table for 21-22 and 22-23. Finally, we will write a comment. Liquid ratios I am more concerned. Remaining ratios we need not analyze this much. Overall analysis we will make and we will go to the next ratio. But liquid ratios are the most important ratios because that will decide whether company will continue or not continue. Therefore, we have to thoroughly analyze current ratio and liquid ratio. Understood up to here? Now tell me, for which year we completed? 21-22. How many ratios we calculated? What are the two? Current ratio. So please write down. For the year 22-23. Only for this we are going to write. From the next ratios we will do directly. For the year ending 31st March 2023. For the year ended 31st March 2023. First one. Let's do together fastly. 5 minutes we should complete this and then we will go to all other ratios. Current ratio. So current ratio first, tell me the formula everyone. Current assets by current liabilities. Current assets by current liabilities. So please tell me the answer. What is a current asset store? Sorry, second year I didn't show now. Please everyone participate. What is the amount? 92,784. Divided by. Sir, please everyone. We have to see all liabilities are current liabilities are. Current liability. How much is a current liability? 39,324. 39,000. Please tell the ratio. 2.1. So tell me previous year how much it is? 2.49. It fell to how much? 2.36, but still it is maintaining a decent current ratio or not? That much small shake will be there in a company during the year's form, but still it is maintaining a decent ratio. But write one comment there. When compared to year 21-22, the current ratio is slightly reduced. The current ratio is slightly reduced by 0.13 by 0.13, but still it is maintaining a decent current ratio. Brackets will write down more than 2:1. More than 2:1. Okay. Are you all with me? Yes, sir, you should only participate. You asked to analyze the balance sheet and P&L. I don't expect any fun here. Balance sheet analysis is a serious task. Are you understanding or not? Don't expect nonsense to go in the class in the name of analysis of balance sheet and P&L. P&L balance sheet analysis is technical and financial analysis of a company. So you have to go deep into the analytical things. I'm not just going to analyze this. Now I will ask you the question on this. Tell me, because of what current liability, current ratio is falling over a 1 year period. 1 second. See, I'm not asking ratio. Listen first. Because of what current ratio has slightly fallen. This is a current assets status. Look at them. Analyze. If you want the information, these are the things. Zoom out means can you see? That's why I'm zooming in. If you can see, okay, no problem for me, I will show. See there. Make an answer. This 1.5 to 2 hours we are going to analyze the full balance sheet in P&L. So spend time, no problem. Learn it properly. See there, I want comments properly. Don't just tell reduced, increased. See there, what might have been affected? Property, plant, equipment. Property, plant and equipment. Okay, 1 second. These are all coming under current or non-current? Answer. So for us, what is required to calculate? Current. These are all property, plant, equipment, capital, work in progress, right of use of assets. All these are what? Answer. We want what assets? See here now. See here, from here. Tell me, first, current assets, inventories, 2719. 27, tell me, previously how much? Now increase it to? Increase or decreased? But current ratio decreased. That means this is not the reason for that. Listening? Next, after that, second, how much is the, what is the second one? Financial assets, like investments. Investments. Investments, how much it is? But it is how much? Increased or decreased? But current ratio decreased. So this is also not the reason. Like this, item by item we need to analyze. Reduce, decrease. Financial managers are there in the company not to comment on it. They have to tell why and how rectifications can be made. If rectification not needed, it's just a general thing. That also they have to comment. Third situation, tell me. Previously, what is a trade receivable? 852. Now 35, 534. Increased or decreased? But current ratio reduced. Therefore, this is also not the reason. Next, 62507264. Again, this is not the reason. This is the important thing. Tell me, how much is the cash balance previously? 81. There is a huge difference now. Cash and cash equivalents have come to 1462. 1462. Why that might happen? Why that might have happened is we need to check the cash flow statement to understand that. Which statement? So, see here. Which statement this is? Cash flow statement. See here now. Trade payables. See this. What is this called? Trade payables. Previously, 2120 is there. How much? Now how much is there? 3686. Okay. This is a one. Like this, if you start analyzing payments, if you see how much payments they have made, 22 year, 23 year, how much amount of payments they have made. Cash flow from investing activity. Cash flow from last year, how much is there? Last year, how much is there? But that inflow has now fallen to how much? In that particular fall, this is one of the contributor, number one. Next, cash flow from operations previously it is how much? 47,397. But how much it is now? 50,852. Cash increased or decreased? Answer, increase. Next, see here, cash flow from operating activity, working capital, operating profit before working capital changes. First see this central. How much is the amount? 36,127. How much is now? 37. Overall cash increased by operations or decreased by operations? Increased. But still the cash balance has reduced. Next. Next one. Net cash used in financing activity. See here now. See this. Tell me. How much is the outflow in the last year for financing? Answer. How much this year? 47,224. That means technically how much increase is there? Substantially how much cash outflow has happened? Almost 14,000 outflow has happened. Correct? In that 14 they might have used cash for some amount. Bank balance as was remaining balance. Repetition one more time. Please listen carefully. Be in this world. Repayment of, at least see there and read repayment of lease liability. Second one is what paid? Next one what paid? Interest paid in cash. Dividend paid in cash. Listening. Transfer of funds to the buyback escrow account. Buyback escrow account. What is buyback escrow account? It is there in buyback section. Buyback escrows. Okay. Transfer of funds from the buyback escrow account. Next one. Expenses for buyback of equity share. Tax on buyback. Buyback of equity shares. Simply to tell, all these buybacks have cash inflow na cash outflow na? Buyback. Company has a cash inflow na cash outflow na? Answer. For that what they have used? Cash and bank balances. Buyback whenever happens, the huge cash outflow will be there or not? Because of that reason cash has went out. This is the reason for the cash fall in the company. That means cash has fallen because of any bad happening or because of a buyback decision. This is what we have to comment. That's why the cash balance has reduced. Are you understanding the point or not? Because of buying back there are lot of advantages. What are all the advantages? We will see in the buyback concept in our syllabus. Listening. We are not going to analyze now and waste your time, but practically first answer my question. Current ratio reduced or increased over a 1 year period? Current ratio reduced or increased? Who is the biggest villain on the assets side? Previously how much it is? Now how much it is? 7,000 difference has come just on that or not? Next. Next. Bank balance has also reduced. Correct or not? That means 5,495 sir. Now it is becoming 3,081. Like that the amounts have reduced. So I collected some debtors. I paid for the buyback. Like that buyback is so many amounts will be used. So the substantial cash outflow has happened because of going for a buyback decision by the company. Are you understanding the point? So please write down as a small comment. Next ratios onwards, fatafat you have to answer. Write down. This company has made a buyback and has made payments out of cash, cash equivalents and bank balances. the company has made a buyback and has made payments out of cash, cash equivalents and bank balances. Due to this, there is a sharp fall in cash, resulting in fall of current ratio. Don't bring bad doubts. Shall I tell you what is a bad doubt here? Sir, buyback 14,000 crores. But here 14,000 crores, the difference is not there. Please sir, this is closing balance. During the year they will go for buyback. Means cash is all adjusted again, we have the cash balances here. 8197, 1462, these are all balances throughout the era, end of the era. Payments will be made at the end of the era for buyback. During the era, before payment, cash will come. After buyback also some cash will come. After adjusting all these are the closing. These are closing cash balances, balances on a particular data. Closing balances, that's all, not every day throughout the year. Did you understand the bad doubt or not? Buyback is for how much amount? How much is the difference here? Technical, almost difference. 6,500 crores, like the difference is there, correct? This is closing balance, only buyback balance. Closing balance, this contains buyback, after that incomes, everything inclusive, this is a cash. One thing we can tell is cash balance reduced, one of the most contributing factor is buyback. That's what we can tell. Clear or not everyone? Sir, I wanted to know exactly, sir. Then you should not see this. You should inspect the books of accounts. For that you should become auditor. Are you understand the point now? I wanted to know exactly, pinpoint every day how much cash is there. For that you should not become analyst. You should become auditor directly. Then you go inspect books of accounts and other books and papers. Then you tell what happened in the company every day. First of all, everyone tell me, these are closing balances, opening balances, okay, any time during the year, closing. In this, receipts are there, cash receipts are there, cash payments are there, buyback is also there. Are you all understanding or not? This is the only buyback balances, overall cash balance, opening, closing. Buyback happens at the end of the day, 31st March buyback, during the year buyback. Before buyback happen, company has cash inflows and outflows or not? After buyback also, company has cash inflows and outflows or not? After adjusting all those, this is a cash balance. These are closing balances, buyback balances. Exactly, do you know how much cash went, how much cash came out using P&L and balance sheet? No, overall only you will know. Understood the point clearly? This is the idea, sir. So comments should be always wise enough. Last one, write down second. What is the second ratio we need to analyze? Write down liquid ratio. Also called as quick ratio. Also called as acid test ratio. Okay. Please participate and tell me what is the formula. Liquid assets by current liabilities. Now there will be a sharp fall. Why there will be a fall? Can you please explain me? Cash is reduced, increase is significantly reduced. Okay. First, everyone, what are all the liquid assets? Count them first. 35, I will tell, count 35 534, 35 534, 7264, 34 534, 7264, 1462 3081 332. 1 minute. 40 673 whole divided by, already we have taken liabilities now 39. Tell me the ratio. 1.21. Previously what is the ratio? 4:6. Difference has come because of payment. First, tell me, company is having a decent liquid ratio or not? Yes, answer. Yes, this is and moreover, listen carefully. Buyback happened or not happened? Before buyback, company has to file with ROC a declaration of solvency, section number 68, subsection number 7. That means they should file all these. That means even after buyback, our debt equity ratio is not going beyond 2:1. Our liquidity ratio is a fantastic. Then only ROC will allow for the buyback. So therefore, they are having a proper liquid ratios. Write down. Even after buyback, company is having a decent liquid ratio of more than 1:1. Decent liquid ratio of more than 1:1. Sir, first of all, the most important ratio is what ratio? Liquid ratio, short-term solvency. From now onwards, we are not going to deeply analyze all the numbers. I will create a pro forma, particulars, the ratio, what we are going to calculate. Listening, what we are going to calculate, let us take immediately where we are going to do ratios for 2021, 22 and 2022 and 23. Lastly, one small comment we will write, we will go to the next one. Shall we? Tell me, can we do, I will ask you questions one by one, answer. Can we calculate debt equity ratio? Yes, answer. Yes, total debt to equity. Yes, what is equity? Equity means what? Equity share capital plus reserves and surplus is called as what? Equity, also called as a owner's equity. Okay na? First, for that we should go to P&L or balance sheet. Okay, I will show you these numbers. Technically try to make a good analysis. See here. They have only given this amount. How much? 74,538. 77,173. Can you please see what it is? Total equity, what is there? Share capital, other equity. Other equity means reserves and surplus and all other reserves. Okay, is there. Total equity they have already given or not? Okay, next. Tell me, what is the total liability? What is the total liability? What's wrong with you? Yes, see there and tell. What is the total liability? 1,19,827. 1,18,000. Sorry, 1,19,000. Now answer my question one by one. What are the debt components in this? Is a question now. There is a share capital, there is equity, this is the total equity. Correct? Now I will ask you a question, answer. First, financial liabilities. What liability? Financial liability. What is the first one? Lease liability. How much? 4,698, 4,879. What is this? Other financial liability. Next one, employee benefit obligations. Next one, deferred tax liability. unearned deferred revenue. These are all liability, non-current liability. Technically, these are called as long-term liabilities. What liability? Long-term liability. First point number 1. Tell me. Lease liability is a debt, not a debt. Answer. Lease is a debt. First point number 1. In accounts, you have one concept called as a leasing. Concept called as a. I will ask you one question. First answer. Lease and loan both are same. Why? I will take 10 lakhs loan from you. Purchase a car. I will take 10 lakhs loan from you. Purchase a car. Okay. On that 10 lakhs, regularly I will pay EMI. Regularly I will pay. Second option. You will give me 10 lakhs worth of asset to me. I will pay the worth of that asset in installment. Options, 2 options I gave you. Everyone tell me. First option, what I have done? Bad analysis. Everyone tell me. First option, what I have taken? Loan. Loan of how much? And purchased what? What I am paying you regularly? Number 1 option. Number 2 option. Second time, you said that I will not give you loan. What? Sir, if you give me loan, what I will buy? I will only give you car, you said. Anyway, you will buy a car. That car I will give you. Okay, you use it. For using it, pay EMI every month. Is there any difference between the first and second one? Maybe transaction wise difference is there, but technically when you see the monetary transaction, both are looking alike or not. That's why finance lease is a loan. That's a long-term debt. Listening or not, everyone? Debt means always it need not be bank loans. You are under a wrong impression. Bank loan is a debt, debenture is a debt. No, lease is also a debt. Listening or not, everyone? See there and tell. First one, what is the first liability? Lease liability. Next one, what is the next liability? Other financial liability. Everyone, other financial. In the law, there will be debentures, bank loans will come. Listening? Next, what is the next one? Employee benefit obligation. Employee benefit obligation. Listen carefully, I will ask a question. Employee benefits we will keep an amount aside. Okay? Employee benefits we will keep an amount aside. I have to, please listen. I have to pay you some amount in future. I have to pay you some amount. So for example, she is an employee. She worked with me for some number of years. She will leave one day. On that day, I have to pay her gratuity, etc. Correct? For that, I am keeping some amount aside, long term. Tell me now. My fund I am keeping aside, or I am taking extra amount from her. Listen carefully. For the benefit of my employees, I am keeping aside my amount, or I am taking a loan from my employee. Not listening. Again, be here, and that's why. You are an employee. Okay. Whenever you are an employee, it is my responsibility to take care of my employees. That's why employee benefits concept came. You worked for 5 years with me. Gratuity is payable. For your name, in your name, I should put some amount aside as a gratuity payable. Paid, payable. Liability, already paid. Long term, short term. Long term. My money, I kept aside. I took 5 lakhs from you. That's all. That's not a debt. That's a liability only. Debt equity ratio, you should not take them. Adi my point is. Listening or not, you have taken money from for employee. You are liable to pay employee when they leave. That's called as a out of pocket liability. What liability? Out of pocket liability. Those are different from debts. Debt is something which you have taken. Liability, debts will be there, others also will be there. Are you understanding or not? I will give you 2 examples now. Everyone in the last benches, please listen carefully. I took loan from bank, 5 lakhs. I kept employee benefit provision for my employee, 5 lakhs. What is the difference between both of them? Some people are not even listening. Again, tell me, I took bank loan of 5 lakh. I kept aside gratuity liability of 5 lakh. What is the difference between both of them? Both are liabilities. What is the first liability type? Money came. Second, money didn't come. Existing money is set aside for the purpose of employee benefits. Did you understand the difference between both of them? That's the difference here. So employee benefits, if comes in exam, a crack fellow like me has to prepare question paper, means practically he will ask. What he will do? Employee benefits he will give in the liability side. On a hadavid batch, liability like this come, debt equity ratio. Debt equity ratio, debt means it is a long term debt. That's a not long term liability. Listening? Now tell me. Lease liability is a debt or not a debt? I am just telling, explaining. I told you the reason for a lease, why it is a debt or not. Lease is a debt. Bank loans and debentures is a debt. Employee benefits is a debt. Deferred tax liability. I am not going to discuss about this now, but it is not a debt. It is reversed in future. Therefore, it's not a debt. Which one is not a debt? Deferred tax. And what is the next one? Unearned and deferred revenue. This is, listening everyone, unearned and deferred revenues they are showing. Deferred revenue means revenue received or not yet received. They are showing it as liability. That is also not a debt. That is the amount which you have not taken. Okay, don't pull that into this. So the main point that I have to tell is, tell me, financial liabilities. Now, how many debts are there in my company? 2 debts. What are the 2 debts? Lease liability, other financial liability. Tell me the total of these two. Tell me the total of these two. 5038. Next. 5397. First of all, everyone tell me why employee benefit is not a debt in debt equity ratio calculation. Understood or not? It is amount received in the form of debt, amount kept aside for payable. There is a difference between debt equity, debt and liability or not? Very good, very good. So this is the situation of my company. Now tell me, equity, had they given the amounts or not in the question? Yes. How much? 74,538. Next one, 77,173. First of all, understand this company is having a highest level of liquidity as well, because there is a least interest cost. If you observe clearly, total debt is only how much? 5,000 over 74,000 of equity. 5,300 over 77,000 of equity. Debt equity ratio is very, 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 very negligible. Are you understanding or not, everyone? That means they are running their company using the own funds only, rather than taking the loans and other liabilities. Such a good company it is. Risky or riskless? That's why it is always one of the fantastic companies to analyze. So, shall we analyze that company now in this regard? So, what are the ratio we calculated now? Debt, equity. I will ask you one small question, answer. I want total debt to equity. Total means long-term debt, short-term debt means current liabilities. Okay, now can you analyze that? I will put the numbers before you. Tell me, these are all current liabilities or normal liabilities? Answer here, everyone. Current liability. These are all the current liabilities. Okay. Technically, short-term debt means only debt nature we have to take. Okay. Short-term lease payables. Everyone tell me. Short-term lease liability. It is a debt or not a debt? Debt. So ticket. Trade payables. Yes, it is a debt. I will tick here. Trade payable is a debt. Next. Creditors payable is a debt. Other financial liabilities is a debt. Okay, next. Next, deferred revenue is a debt or not a debt? Not a debt. So let's not consider this. Other liabilities are there. What liabilities? Other liabilities. So provisions, employee benefits, taxes, all these are not debts. These are only liabilities. Okay. Other liabilities also should not be taken. So how many debts are there? Short-term debts. 4. Please tell me the total of all the 4 from where we should start. 9612 2962. Likewise, here also you should total these amounts. 296. Oh, sorry. I'm very sorry. These. Please total them. 21 670 7. Here 16,384. 884, 16,884. Okay. So now answer my question. One small analysis. I have given you the details of total debt now. What debt? Total debt. Now can you tell me the total debt to the equity calculation? This is the equity. Equity. Tell me. Take calculators everyone. Total debt to equity. Calculator, tell me. 0.36. Second year 22 23. 0. Let's analyze these ratios now. Please keep the heading capital structure ratio analysis. Directly write the answers now. No great analysis required. Write down. Capital structure ratios. Particulars. '21, '22 and '22, '23. Capital structure ratios. First, A. Debt equity ratio. Debt equity ratio. First, everyone, please spell out the formula for debt equity ratio. Debt long term divided by equity. Divided by equity. Please tell me the answer. See here. See the screen. Give me the answer. Debt means we have to take which debt first? Long term debt. What is a long term debt? 5397 divided by 77,173. Shall we do that? Write down. 5397 divided by 5397 divided by 77,173 equal to, tell me, 0.0:1. Means substantially, if you observe, for every 1 rupee of own fund, 7 paisa debt fund is involved. Means substantially the company is carried out using whose funds? Owners funds are carried out. That's why share price is having that much value. Got the point or not? That means entirely total benefit of the company is flowing to whom? Owners of the company. Next, to the other side of the story also, please analyze, sir, everyone. Take calculator. 5038 by 74,538. 5038 divided by how much it is? Abba, how managing they are doing. That means they are not going beyond that ratio of 0.07:1. That 007 fantasy. So write down. What comment you have to give on this? I want that answer first. You are very busy in copying, but answer this. What comment you have to make on this? Company is conducting its business substantially using the owner's funds than the lender's funds. Borrowed funds are very less. Right now. Company's business is substantially carried out using owned funds rather than borrowed funds. And hence finance risk of the company is negligible. Leverages chapter we will see what is a finance risk, business risk, combined risk, all these. Finance risk is negligible. Next, B. So debt equity ratio completed. What is the next ratio we are going to calculate? Total debt to equity. Total debt to equity. Please write down particulars. Write down. Short-term debt A. Please see this and answer. Short-term debt means current or non-current. We have to take current. Tell me how much? 16,884. Next, 21,677. 21,677. Long-term debt already you calculated previously. Please everyone help me with the numbers. Long-term debt already just now you have calculated. 5397 5038. Total debt. Tell me how much? 22. Next. 7. This is the total debt. Next, equity already have done in the previous 77 Next year 74,538. Ratio 0.29:1. Next one 0.36:1. Even in this case, for every 1 rupee of equity, only how much debt is there? 0.29 and 0.36. That's all. You need not comment the same answer. Substantially low debt is there, therefore company is having the lowest finance risk. From the capital structure ratios also we have completed 2 ratios. Like that every area 2 ratios let us take and close. Like this you can sit and calculate in number of ratios of the company. But main what is required, let us see. Sir, tell me, now 2 things we completed. Guess what are the 2 things? Short-term solvency, long-term solvency we confirm. This company will live longer, will not live longer? Answer, will live long. Long live Tata Group. So this company will live for so long period because in the near future I could not see anything shaking this company because no debts are there, only equity funds are there. So that can be one of the reason why lot of equity is piling up now, they are going for buyback. Are you understanding the point or not? Heavy equity is growing up, so they are going for a buyback. Sir, okay, everyone understood the 2 ratios or not? Everyone? Yes, tell me, 2 ratios we completed. What are the 2 ratios? Short-term solvency, long-term solvency. Lastly, put one comment. Solvency status of TCS. Solvency status of TCS. Since the company is having better than ideal liquidity and capital structure ratios, TCS is absolutely solvent, short run as well as in a long run. Short run as well as in the long run. Okay. So now, so tell me, let us also see 2 to 3 activity ratios. Give the information of what you know about activity ratios. Tell me. What are the activity ratios you know personally? Tell me. Hey, how many we have done here? Why you are seeing my face? Tell me. Capital. Next. Fixed assets turnover ratio. Next. Debtors turnover ratio. Next. Stock turnover ratios. Yes or no? After that, tell me. Performance ratios can you see? Performance, activity over, I mean sales to turnover ratios type, gross profit, net profit, operating profit. Can you calculate that? First let us see that particular area. Okay, write down. Sales turnover ratio. Okay, sorry. Asset turnover ratio. That means all assets, fixed assets turnover. Okay. Capital turnover, all these turnovers we can calculate. Next after that, Or else we will see one thing first. We will see the gross profit ratio, net profit ratio, operating profit ratio. These three ratios let us calculate first. What are the three? What we call as gross profit, net profit, all these ratios? Profitability ratios. Tell me what are the three profitability ratios we are going to see now? Gross profit ratio, net profit ratio. In these companies generally gross profits and all these will not be there. Directly they will move on to which one? Directly they will go into, I will show you standalone financial statements. See here it is given. Please see there. Quarterly reporting we don't require. I will ask you only one point. Please see that and tell. Please read what it is. These are quarterly, these are annual. Last year how much is the profit? 38,187 crores. What is the profit for this year? Answer? This is after all the taxes are not. That means this is a profit after tax. This is profit after tax. Okay. This is profit after tax. On this only we have to analyze everything. Remaining all our accounting adjustments, you should not touch them. Okay. Mainly analytically profit after tax is important for us. This is a net profit, gross profit. Answer? Very good. Now I will ask you one question. Answer. What is this? Profit before tax. That means tax expenses are deducted from that. Correct or not? Now think and answer. I want profit before interest and tax. What I should do? Add this. What I need to add? Finance cost I have to add. What I have to add? What I have to add? If I add finance cost, I will get operating profit. Which profit I will get? Operating profit. So tell me, what is the total income? What is the total income? 1,67,827 crores. 1,95,682 crores. What are these two? Incomes. After expenses are? Before expenses are? From that, what is the first expense? Salaries. Second one? License cost, all these. Sir, software company runs on licenses or not? Direct operating cost. Finance cost is what cost? Interest cost. Next one. Sir, lease rentals you have to pay or not? What you have to pay? Loan I have taken. Interest I have to pay. Lease ki rental I have to pay. All those will come under the finance cost. Lease is a debt. Lease rental will become a finance cost. Listening. Next. What is the next one? Depreciation and amortization. And what is this? Other. Okay. Now listen carefully. Can we calculate two ratios or not? Operating profit and net profit ratio. Operating profit and net profit ratio. Tell me what is the formula for operating profit ratio? Operating profit by sales. Operating profit by sales means what? Revenue. How much? How much? No, this is not. This 1,60,341. Only operations we have to take. TCS is having a vacant land, agricultural land. That agricultural land is giving a revenue. That is operation, the non-operative. You should not consider them. Are you understanding the point or not? So always we should consider only which one? Operating and operating profit considers only operating income. Net profit will consider all incomes. Hello? Shall we do the analysis? First, what we need to calculate? Operating profit. Let's start. Profitability ratio. Keep the heading. Profitability ratios. Write down. Particulars. No noise, please. '21, '22, '22, '23. First. A. Operating profit ratio. Tell me, what is the formula? Operating profit divided by into 100, or operative revenue into 100. Please, everyone first tell me, see the screen and tell me, revenue from operations, how much? 160, 341, 190, 354. Correct? 160, 341, 190, 354. What are these two? First tell me. Sales type, revenues, operating revenues. Okay, na? From this, first one, tell me one by one. Can I deduct employee benefit? Hey, from this, can I deduct employee benefit? Employee benefit is operating expense or not? Can I deduct the license cost? Can I deduct finance cost? No. Next one, can I deduct depreciation and amortization? Yes. Can I deduct all other expenses related? Yes. Listening? With this, what we will get? Operating profit. After that, also called as a EBIT. Can we? Right now. Operating revenues. I want clarity from you. Operating revenues. First, which year we have to write? 21, 22. What is operating revenue? 160, 341. Next year, 190, 354. Number 2. Operating expenses. Operating expenses. Operating expenses. You can do in two ways. Separately you can do, or directly from the total expense. What we have to remove? Finance cost. This you have to remove. 143, 118,104 minus 486. 118,104 minus 486. 117. Next, 143,992 minus 695. 143, 290. First, always everyone tell me, this company is having higher debt, negligible debt. That's why debt expense is also, see how much less it is. For them it is negligible. Okay. So tell me 117, 618. One 618, 143, 297. Number 3, what we call it? EBIT, also called as operating profit. Tell me amounts, please. Tell the value. 427. Next, 4057. 47057. Okay. Operating profit we obtained. What is the next one we need to write? Operating revenues we have, operating expenses we have, EBIT also we have. Just what we calculate? Ratio. Percentage we need to tell actually. Percentage of EBIT on sales. Tell me, working I will write below. 42,723 divided by 1,60,341. 26.65%. Likewise, 47,057 divided by 1,90,354. 24. So therefore this is a classic example to tell, don't judge on the basis of numbers, judge on the basis of percentages. Technically last year amount is more, percentage is less. Correct or not? So on an intra-firm comparison, tell me, performance of the company over a 1 year period, increased or reduced? Increased. So sorry, it is reduced. 26.65 has come to how much? 24.72. Numbers you don't see, percentages you see. Previously how much it is? 26.62. Now how much it is? Means it is an indicator that we are spending more operating expenses for a lesser revenue generated. There is a sharp, small, negligible difference over a period of 1 year, but no problem, it is maintaining a very good operating profit ratio. So simply, what is operating profit percentage on sales? First year 26%. Next year? Next year 24%. There is a very negligible change is there, but change is there. Just the comment is, though there is a little fall in the revenue, but that is not going to show any kind of change. So if you observe, numbers are more in the second year. See there, yeah, numbers are more in the second year, but the percentage is more or less less. Therefore, don't judge on the basis of numbers. Judge on the basis of what? Percentages. If you see the overall numbers, which is more, 22-23 is more, but when you calculate as a percentage, it is less. So therefore, please write one small comment. As regards to operating profit ratio, the company has very good percentage of profit recovery. Though there is a slight fall by percentage change, you tell me, 26.65 minus 24.72. How much? 1.93. So the overall idea is, what expenses have increased? Operating expenses. For the increase in operating expenses, that much sales are not increased. Clear? So to analytically present this more better, I'm not going to write that, you just tell me, see the numbers and tell me 117, take calculator, 117618 divided by 16341. 117618 by 16341. 73.35. From this, what you have to understand, for every 100 rupee of sale, how much is going in the form of expense? 73. Next year you calculate. 143,297 divided by 195,34. 354. That means for every 100 rupee, you spend how much now? 75. That means sale is same 100, but your expenses have increased. That's how we can analyze it. That means a little amount of expenses they incurred more on operations this year. Listening everyone? Last one. B. Net profit ratio. Net profit ratio. Over a 2 years period, let us do. Please tell me what is the formula for the net profit ratio? Net profit ratio equal to profit after tax divided by operating revenue. Into 100. Sometimes you can also take total revenues, but it is wise to take only operating revenues. If you want, you can write operating revenues or total revenues also you can take. No problem. So take total revenues and do. 1 point we have done using operations. This one we will take total revenues and solve. And please tell me, number 1, what is the total revenue of this particular company this year? See there and tell me the numbers once. Please help me with the numbers. What is the numbers? 167, 827. Next, 195, 682. Next, number 2. Total revenue over profit after tax. See this ones. 38, 187. Next, 39, 106. Tell me, 38, 187 divided by 167, 827 into 100. 22.75. 39, 106 divided by 195, 682. 19.98. 98. Almost equal to 20%. So here also there is a slight fall of 2.75%. That means what is more during this year? Expenses. What is more? Expenses. That's why annual general meeting time 21 days before the AGM, we will give financial statements to the shareholders. They have to do all this analysis. They have to question the board of directors in the AGM. Why there is a fall by 2.75? What extra expenses you kept? Are you understanding or not? That's why annual general meetings are conducted, not for lunch and brunch. Are you understanding or not? They conduct annual general meetings such that at least shareholders get a chance to question them. Why these expenses have increased? Last year it is 22.75. Now it is 20. There is a fall by 2.75. What is the reason? When they put the money, they have right to ask the questions. So they will ask the question. For that they kept. Okay. Now answer my question, sir. Had we completed 3 main important ratios in analysis or not? What are the 3? First one is what? Liquidity ratios. Next one what? Capital structure ratio. Next one is what? Profitability ratio. Last one thing is there. Without that, it is always incomplete. The person who invests money wanted to know how much return he has got. Who is that fellow? Return on equity. When we keep money, we wanted to know how much return you are giving to us. Equity shareholders will receive EBIT, EBT, EAT. Equity care in the question or not? There. Profit after tax is there or not? There. Can we calculate the return on equity? Answer. Return on equity, can we calculate? Yes, we can calculate return on equity. Next, can we calculate return on total assets? How assets are utilized in the company? Can we also calculate that? 2:2 ratios will calculate and close. Please, that information is there in the balance sheet itself. Please write there miscellaneous. Miscellaneous. Write down. Return on equity. Return on equity. First tell the formula. PAT by equity. PAT by equity. Next, please tell me the answers for 2 years, 21, 22, 22, 23. Tell me the answers. What is the PAT? Everyone? 38,000. Next. 39,106. Second number also there with you already. What is the equity amount of the company? 77? 173. Second. 538. Return percentage. First percent, tell me. 49.48. Next. 52 point. Why share prices increases? Because of this reason increase. Whatever may happen to the company with regard to profit or loss, you are giving me more return for my investment. Are you understanding or not? For every 1 rupee, you are giving how much return to us? 52% return per annum. Are you understanding or not? This is a situation. So this is a return. Return equity increased or decreased? Increased. Just give a mark. That there is a increase. Yes. Next, B. B. What is the second one I said? Return on assets. Return on assets or total assets, anything. Profit after tax by. Profit after tax by total assets. Okay. Tell me here, what is the, please, no noise, write down, we completed almost profit after tax. How much it is? Next, B, total assets. See here, total assets. See there, 121, 263, 119, 827. 121, 263. 121, 263. Next one is 119, 827. Written as a percentage. One second, tell me how much? Next one, 32 point 63 or 64. Now tell me again, during the year their utilization of assets onto the revenues is increased or decreased? Increased. That's all. That's why this company has performed well throughout the year. So now tell me, what is the health of TCS? On a scale of 10, if you have to give the health status, what is the health of TCS? Answer? So it is a 10 on 10 company, one of the best companies. That's why credit rating, it is standing top in India. So, sorry, okay, everyone in the class, are you satisfied with the analysis? Yes, as promised, the TCS balance sheet P&L also is analyzed. Okay, thank you very much. Next session, we continue with our normal cost of capital, analyzing those results. Okay, so thank you very much.